Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best that you can be. My name is HarveyBracken-Smith, and today I'm honoured to be joined by Lihong Wang. Lihong is the founder of Freeport, which is a Y Combinator-backed company that is the interfacing layer of DeFi investing. He formerly worked as a quant trader at IMC Trading and completed internships at both Jane Street and Akuna Capital. He's also a graduate of Duke University. I feel very honoured to speak to you today, Lihong. I've heard great things. I wanted to get started by asking you, why get into quant and how did you break into it?
Okay, so I think I can start with the first part first, why going to quant. To be honest, I grew up in Dubai actually, so I just came to US for college. So going to trading, I actually didn't even know the industry existed until I first came to Duke. I remember actually meeting a friend freshman year who told me that, his neighbors were in quant trading, and this was a pretty good friend that I still can keep in contact now. And we met in linear algebra, and at the time he knew that I really liked doing math, really liked analyzing things, thought really quantitatively, and that was the sector he suggested I look into. And for me, kind of looked into it. I've kind of always been interested in stocks and options, and kind of having joined college during COVID, that was the time when I think a lot of retail investing got really popular. So I was part of that kind of Robin Hood crowd who bought GME options. And kind of, the mechanics of how kind of GameStop got short squeezed and just how asymmetric returns could be versus just normal market returns, that was something very appealing. And for me, being able to study that systematically and being able to, actually realize edge in the market was something very exciting. So for me, that was one of the main reasons that I started looking into industry. And as for how I broke in, I think for me it was kind of the, if you will, standard path of just doing technical things in school, applying to internships, getting experience. Yeah.
I think it's really interesting you mentioned GameStop. I think I was kind of interested in the stock market a few years prior to that, just in terms of my own general interest. I did have a little bit of money invested in the market, but I wasn't as committed to it. But I think GME was kind of one of the first times that I was reading the news every single day, and I was just in such awe about sort of the retail traders versus the big hedge funds and quantitative hedge funds. Particularly, I think it was Melvin Capital, I think was the hedge fund that kind of got majorly impacted by it. What was it sort of like at that time? Was it a friend suggested GameStop to you? How early in did you get? Were you successful? Did you manage to get out in time? Can you talk a little bit about what that whole experience was like?
Yeah, it makes sense. Yeah, I can talk a little bit. I think for me, it was friends at first suggesting, and also it was blowing up on Twitter, and then, it was also kind of starting to show up on Reddit before it started showing up on the news. So got in, I would say reasonably early, and also got out maybe a little bit too early. But it was better than getting out too late, I guess. So I think at the time, it's I think the mindset of retail trading versus the mindset of a quantitative trader is very different. At the time, I was definitely, closer to being a retail trader, where all of your decisions are, I guess, mostly driven by emotion and less by analysis. To be completely honest with myself, it was much closer to gambling than actually trading or investing. But nonetheless, it was very fun. So yeah.
Yeah, I think it's very interesting that you were kind of on that retail side, because in how the media sort of portrayed it, if you kind of ask these hedge fund managers beforehand, they talk about generating alpha, this sort of perfectly, not perfectly, but very competitive environment. And then suddenly when these retail investors go from, oh yeah, these are people we don't really worry about, to the big impact of GME, which, GameStop, which then had an impact on Melvin Capital and hedge funds as a whole, all the hedge funds suddenly kind of banded together. I think Ken Griffin helped to bail out Melvin Capital. This seems like kind of a stupid question to ask, but did you not feel at all a little bit of loyalty to the retail investors? Because the sort of hedge funds and big quant firms are sort of the opposition to the retail investors, and yet you've flipped sides and joined them a few years later.
Okay, so I think the way I like to think about it is not necessarily hedge funds versus retail investors, but rather what structure in the market actually allows the market to perform its proper functioning in the efficient allocation of capital and resources. And I think in popular narrative, there's a lot of the GameStop is the normal common person going against the elites or hedge funds on Wall Street. But fundamentally, my take is that when you have a significant dislocation in pricing, such as what happened with GameStop, fundamentally that is a disservice to the market, and fundamentally it's not a great thing if the country's engine of economic growth is turned into a casino. So I think also on Reddit at the time there were a few things people really didn't like that institutions were doing. So one was kind of stock trading halts where when GME really squeezed, NYSE would kind of halt trading to be able to aggregate liquidity to kind of use an auction to maybe provide the liquidity the stock needed to stop squeezing higher. So for retail, that's like, hey, why are these systems in place to stop the price of the stock squeezing higher? But then from someone who actually thinks about market microstructure a little bit more, you're like, well, the reason it's squeezing is not because the stock is fundamentally worth that much. It's because there's a lack of liquidity. So you want market mechanisms that can actually aggregate liquidity, such as in single price auctions, and that's fundamentally beneficial to markets.
Yeah, it's still kind of delving into the internships thing. I think quantitative internships are some of the most popular in the world. I recently interviewed the chief people officer of Citadel Securities, which I think they always pick 1%. It might even be less than 1%, but they always pick 1% for all these internship programs, just to show how rare and how hard it is to get in. You mentioned you kind of prepared, and obviously you're at a top school like Duke, but what do you think differentiated yourself throughout the process? What did you do that enabled you to get into one of the best quantitative hedge funds or quantitative firms in the world?
Okay, so I think from my side, I think there's maybe a few things that in general people could do. I think first is like an actual demonstrated interest in the industry. I think especially for students at some of the target schools that these firms try to actually target, there's a lot of networking events. There's a lot of competitions hosted by these firms that you can go to, and if you kind of take the initiative to actually go, I think on one side, the recruiter sees you, they put like a face to the resume, that's pretty good. On the other side, it shows that the firm you actually care. Because in terms of the people who I think, go into these firms in the internships, there's two types. One are people who actually really love markets and really want to do trading. And two are, generally really smart people who could be really good at trading, but, it's up to the firm to convince them that that's what they should spend their lives doing. So I think on the firm side, if you think about their incentives, they're going to spend a lot of money per intern on their program. They want to make sure that not only are you capable, but it's actually something that you want to do, right? If you answer the interview questions correctly, then you're showing, you're smart enough to do it. But then, they also want to see that you would actually be committed.
Yeah, but what does the actual basis of longevity around quant firms look like? Because over the past few years, there have been incredible pay packages, reaching $10, $20, $50, $60,000 a month base for interns and for people starting off. What does the longevity look like? Do you think it's worth it? And what does the future look like of quantitative trading?
Okay, so I'm not going to pretend to be, actually understand where the industry is going to go in the next 5 to 10 years, because I don't think anyone does. But in terms of the compensation, I think there's probably a few reasons for it. One, I think, is the fact that just trading activity in the US has blew up. So especially around very profitable instruments like options for these firms versus just vanilla stocks. The second is, I think, crypto at the same time is very profitable as well. The second is competition with kind of stuff on the West Coast, all these AI firms handing out even crazier packages. In terms of, the group of people that they're targeting, I think there's a pretty big overlap between, people being hired by, let's say, HRT or Jane Street for their, quant researchers, and the people being trying to poached by Meta or OpenAI for AI research. And obviously, as, so much more money is being pumped into AI, you're creating kind of this artificial demand for talent at the top, where, I guess, like, even for out of college grads, like people's like salaries are just getting squeezed up. So
on the basis of retail investing, as we were talking about, Robinhood has reached a market cap, I think, of more than 90 billion. We've got other big trading platforms such as eToro, reaching sky high valuations, as well as crypto, as you kind of mentioned. It gives this perspective that it makes it seem like retail investors have an opportunity to make a lot of money, particularly being given a lot of leverage opportunities. But I think there's a statistic that like 95% of traders will still lose money. And so do you think that retail investors actually stand an opportunity to make money? Do you think it is making the markets more competitive? Or do you think it is literally just like gambling for the average retail investor when people like Jane Street, people like IMC, people like Citadel Securities have so much more information and data who might actually just be taking this money year over year as they win more consistently?
Okay, yeah, I think that was a multi-part question. I'm gonna kind of start with the first part about people making money. So I think if making money, you're saying versus losing money. I think in general, when the market is going up, most people who are investing are gonna make money. If you mean making money as in beating the market, then that's a very different question. Basically, if you look at everyone's positions in the world, you add them together, that is the market, right? So mathematically, it is quite literally impossible for the majority of the people to beat the market, since the market is the average when you weight it by how much money people have. And obviously, certain participants in the market are more sophisticated than others, and it will be unnatural to expect the less sophisticated participants to be able to beat the more sophisticated participants in active trading over time. However, I will say that if you're talking about being able to have a better risk-adjusted return or long-term return than the S&P 500, I do think there is a few number of things that retail investors can do for kind of long-term investing, as opposed to kind of day trading sort of behavior that they could do. The first one is obviously just buying the S&P 500 on a little bit of leverage. Let's say you're 20% leverage or 23% leverage on the S&P 500. If the stock market usually goes up, then over 10 to 20 years you can expect to beat the S&P 500 by like 2 to 300% or something like that.
Sure. I want to delve into two last questions based on quants before moving on to your company, Freeport. Something that's kind of been told to me by many people in finance is that Jane Street in particular, I know you used to work at IMC, but Jane Street is often viewed as this like cult-like place in terms of people being very secretive about it, not wanting to talk about it. Could you shed a bit of light on what working at Jane Street is actually like?
So I think what you said about being secretive is definitely true, because I interned there, and then I think for their intern projects they try to not give people anything that's too sensitive about the company, and obviously people don't mention what trading strategies the company actually is doing. I think if you look at the recent cases they've been having in India, maybe it's natural they don't want to share what some of the stuff they're doing is. But I also don't think that applies only to Jane Street. Because in general, when you have a global trading firm, and that's any global trading firm, and you have again a very sophisticated player operating in markets where the markets are regulated by significantly less sophisticated regulators, you have a case where certain type of trades, which again may not be the best for market integrity and market well functioning, can be very profitable to the trading firms. And in general, I think that's a general reason why trading firms themselves don't like to talk about everything that they're doing.
And what was that sort of culture like at Jane Street versus IMC?
So I think culture is. I don't want to talk like too much about the cultural differences, because I think again it really depends on what desk you're on, what exact group of people you are with. But in general, I think in both places, you have very intellectually curious people, very driven people, and also, obviously they like money. That's why they're in trading. But just people who are pretty good to work with. I think both places are, some of the best places to work with in the world. So.
And are people social, or is it very much just head down in the books? Are people working more than 40 hours a week, or is it just clock in, clock out? What's that like?
Yeah. Okay. So I think as with any highly competitive career, everyone's obviously working more than 40 hours a week, right? Like you can't, no one's doing 9 to 5 in high finance, obviously. And as to culture and personality, again, really depends on the desk. I think, obviously if you're on like kind of a more discretionary driven desk where people actually, care about the news, where people actually need to talk to each other, then naturally the personalities are gonna be more social. If it's something that's, highly research driven, purely systematic, it's just like data all day, then that lends itself to definitely another type of personality. But I think whatever like personality you have, the firm can find somewhere where you're comfortable with generally.
And it's become sort of a buzzword these days, but the concept of AI, as that's kind of gone all amongst the world, like what impact has that had? And has the rise of stuff like ChatGPT, has that actually had an impact on quant firms, or was this stuff that they were doing 10 or 20 years ago already?
I think there's maybe two aspects to think about it. One is just general productivity. So, for example, I think it was Claude that recently kind of tweeted that a lot of their code was just written by AI. I think that's also getting more true at trading firms, where a lot of the code, at least for like data research, something that doesn't relate to the trading system directly, you could just automate with AI, and that just makes the research process so much faster. That's one aspect. The other aspect I think is using AI to actually find signals. And for me, because most of my experience have been kind of more on the discretionary trading side or like the semi-systematic side, that's not the type of research stuff that I've personally been super involved in. But just from talking to people and a lot of my friends, it does seem that there are a decent number of firms that are kind of using the extra technology that's available now to actually find signals and apply them.
All right, so you go to one of the best universities, the sixth best university in the world, in the US, Duke. You work at the likes of Jane Street, Akuna Capital, IMC for a year. You're earning God knows how much money a month. You're doing extraordinarily well by pretty much every single measure, and you've kind of got the dream job of people throughout the world doing something that you love. Why leave? Why not just put your head down, earn some more money, retire in 5, 10 years? Why risk it all to build your own company?
So I can talk a little bit about that. I think you can come up with many reasons, but like fundamentally, I think it's just about the person itself. If you feel like you're in the right place or where you should be. So I think for me, like remember back in college when I was like president of a few college clubs, working really closely with people who I love on something I really care about. That's when I actually felt deeply, deeply fulfilled. Whereas kind of going into a job, at first it was really exciting, but I think at some point things become somewhat repetitive. It's just same routine every day. Obviously, I love my coworkers; they're great people, but it's not the same type of bond you have with I think your closest friends in college or the people who I'm working with right now in my startup. So like for me, I think it just felt something was off, and I look at myself and I'm 23. There's I want to do something with my life or at least try. So why not? Like fuck it, full send. And I think the other thing is financial security. Having done these internships, having invested my earnings from these internships very aggressively into the market, I feel like there was like a pretty good nest egg there where I wasn't immediately concerned about just like paying living expenses for at least the next few years. So I didn't really feel like it was a massive risk. That plus I guess I really support a family. So
I think there's also an aspect to which being incredibly technical, I mean, something adjacently with the rise of AI, with Meta paying huge pay packages, there's only a limited amount of people with the level of technical skills at these top firms in the world. And so that even if you did leave one of these companies, I mean, even looking at your resume, you've got your GitHub up there, you can build projects to be able to get into another company in the future.
yeah.
So it's not like you're permanently shutting the door, like these technical skills will always have like some form of value. So you realize that you're not feeling that comfortable, not that you're not feeling comfortable, but it's just not really your dream and how you want to spend your day-to-day basis. You've built up your nest egg. How do you come up with the idea for Freeport? And at what point do you go from, okay, this is just another idea to something this is this is what I want to pursue? Like, are you building it while you're at IMC? Like, do you have time on the weekends? And at what point do you decide, all right, I'm going to leave my job and I'm going to go all in on this?
Okay. So I think for me, I can talk a little bit about the idea first, I guess. So the idea for us, is the interfacing layer for DeFi investing. So right now, most people holding crypto, they hold it on Robinhood, Coinbase, or Kraken, which takes custody of your assets instead of holding it in a self-custody wallet. But if you were holding it in a self-custody wallet, there's a lot of cool stuff you could do, which, if you're not doing, you're somewhat, just leaving money on the table. So for example, let's say you're holding Bitcoin, and, just getting that exposure. If you're holding it on Robinhood or Coinbase, you can't really get any interest on your Bitcoin. But if you hold it in a self-custody wallet, you can go on protocols where you can lend it out to, exchanges, people like Binance, Hyperliquid, or you can, lend it out to other just, I guess, traders in an over-collateralized lending pool with the level of risk that you want to control. And by not lending out that Bitcoin, you're probably leaving anywhere between kind of 2 to 7% on the table every year on your entire Bitcoin stack, depending, what level of risk of lending you're doing. Same thing for, let's say, Ethereum. If you're holding a self-custody wallet, you can stake your ETH and then kind of get 5 to 7% there. And, that's something that you're just not doing if you're using a normal platform. However, the problem is, as I kind of got into this over the last few years, is if you have a self-custody wallet, you want to do all these cool stuff on DeFi, both kind of the optimizations as well as, more kind of exotic type of trades, which you want to do. It's very fragmented. You're probably kind of, juggling between like 5 to 6 different protocols on like 3 different wallets. And also, just before you put your money anywhere, there's so much research you need to do just to make sure it's not a freaking scam that, I think for the typical person, these things have been made inaccessible. And, for me, I was doing this and I was just calling some of my other friends who also held crypto. I'm like, so yeah, there's this protocol out here, it's really cool. It's doing XYZ. It looks pretty legit. They're backed by, Sequoia, A16Z, whatever, public, trustworthy people. Why are we not doing this? And they're like, guys, dude, I'm, working a fucking job. I don't have time to look into all of this. So, at that point, through these conversations, it kind of became obvious that this was a real problem that people were facing. And that, kind of now with deregulation happening and kind of more tools in DeFi being built up, this was kind of the time to build something that actually aggregates these functionalities and actually presents them in one platform to the consumer. And, at that point, ideally, you can capture the consumer and monetize that direct relationship. Why kind of do the startup was I building IMC? I think when I was IMC, I think that's the same with any trading firm. On the weekends, you're pretty tired. You don't really have a lot of time to build. So for me, I think it was less confidence about a particular problem or a particular idea versus more confidence about, I think it is the right time to build in crypto right now. And I think I have the ability, along with my co-founder, to find a problem that people actually need solving and actually solve it.
So did you just decide one day, I'm going to quit my job and start from scratch, or had you already built some of it?
I think by the time when I left my job, I didn't actually build anything at that point. The main reason for that particular timing was actually my co-founder. His name's Brian. He just graduated from UNC, and he's also a very technical guy. When he was in his senior year at UNC, he built a software testing business where he sold software to various local companies, and he actually made a little bit more, over $200K off that. So, I've known this kid for 4 years. We've been pretty close. And he was graduating. I think his parents was trying to get him to, get a job. And that's when I realized, kind of the longer you're out of college, the more difficult it is for you to find a co-founder who is aligned and willing to take that risk just by the selection bias of people who still have a job at that point. So I was like, now really is the time.
So sort of taking a step back, of the people listening, people that are super into the quant world or the crypto world, or even have a little bit of crypto, probably understand all of the terminology that we've talked about. But in terms of people that are listening, maybe don't know much about quant, don't know much about crypto, basically when you own cryptocurrency, as you were explaining, you don't actually have the exact wallet that it's in. You simply buy it and Coinbase or whatever will hold on to it. So you can't actually hold on to the crypto yourself. Why this is so important is things like Bitcoin and Ethereum are known as decentralized currencies. So you see that they're often doing well with the falling of the US dollar or the pound, because they're basically moving away from the inflationary environments of the fiat currency to basically move more towards cryptocurrency, which is on the blockchain, decentralized, being marked off by different computers all around the world. Yeah. So basically, if the whole point of it is to be decentralized, you would want to own the wallet. So that means that no hacker, no one else can get involved and actually get the actual currency that you have in Bitcoin. But what's happening is people like Robinhood, well, companies like Robinhood, companies like Binance, Coinbase, etc. When you actually go onto those sites, you don't have your own wallet. You actually, they hold it centrally on their own platform. But as Lihong has been explaining, is that you can actually lend out your cryptocurrency to other companies, even maybe back to Coinbase itself, when they have to have their own risk book, and they'll pay you between 2 to 7%. So if Bitcoin was to go up 10%, 50%, 100%, or down 50% in a year, even though you're long-term holding that crypto, you can actually what's known as staking, aka lend it out to someone else, just like the money in a bank, in order to make extra money on that. I just wanted to add that, but going back to that original point in terms of staking itself and the legitimacy of finding certain wallets, you're not going to have maybe you do, maybe you have to use AI, maybe you have to find publicly sourced sort of people building in public to get verification, or people themselves. How are you going to go about verifying staking wallets? How can the consumer know, all right, I've got my Bitcoin. Maybe I have $1,000 of Bitcoin, which for me is a lot of money, or 100,000, who knows? And Bitcoin's gone up by 50% or whatever it has this year. To risk $100,000 or $10,000 or $1,000 to make an extra $20, $2,000, $7,000, whatever it is, it seems like, sure, that can help in growing your money, but it's a big risk for something that is not that known about. So how are you going to go about verifying these individual companies to stake against?
Yeah, so I can talk a little bit about that. So I think there's depending on exactly what type of yield you're trying to get, there are different risks involved, and there's different ways to analyze that risk. So let's just start with I think staking, which is I think slightly different than lending. So for example, with Bitcoin, you can't really stake it. Staking you can only use with what's called a proof of stake cryptocurrencies, so something like Ethereum. So what is essentially happening is Ethereum transactions, they're just recordings on a decentralized ledger, but the actual entries in the ledger are confirmed by people who stake their tokens, and then they vote on what the true ledger record is. And kind of the game theory optimal thing here is to vote with what actually happened, because the incentives are that if you vote against the majority, then you get your stake slashed and you lose money. So what you can do is you can take your Ethereum, you can put it into one of these staking pools, and then they just vote basically correctly to confirm what's going to happen on the ledger, and then they would give you the rewards. And the risks there is obviously like one, if the staking pool is a scam, then you lose your money. Or two, if someone launches what's called a proof of stake attack on Ethereum, they gain the control of the majority of the voting on ETH, and then start kind of just creating false records. So like first with the staking pool, I think there's like pretty well recognized staking pools out there that people just know is legit, that for example banks use, large institutions already engaging, and that have been audited. That's like massive companies, for example one is called Aave or Lido, for lending and staking respectively. So I think kind of bring back to like the idea of Freeport is these things are already out there. The things that are being built is already being built by pretty massive billion-dollar companies that we kind of just know are legitimate, or as legitimate as any other billion-dollar company. So like for us, on our side, there's not really that much question about safety. We think they're pretty safe. As to the consumer, I think there's like 2 points, or like 2 to 3 things we can do. I think one is potentially just like provide insurance. For example, in the traditional banking system, obviously everything is FDIC insured, but in DeFi, you don't really have that, automatic insurance on everything that you have. However, there's also decentralized insurance firms, which you can use to buy insurance on certain amounts of deposits for your customers. And also, you don't really have to also buy them from a decentralized insurance firm. You can just go to a normal insurance company, let's say, State Farm or Progressive or someone, and just be like, hey, can I, pay you a premium to insure all of these things? And again, as long as you're engaged with legitimate protocols, then these insurance firms who understand these protocols, they would give you kind of a very low insurance premium to help you insure, just because they also know it's pretty safe.
But sorry, I know you've literally just explained this concept, but can you explain the staking thing a bit more simply? I don't get the idea of if you vote against it, you lose your money. Can you, go into a bit more detail on that?
Yeah, yeah.
As if explaining to a 5-year-old, ChatGPT explain to a 5-year-old.
So I guess the one way to think about it is, let's say we're like in a group of room with like literally 5 people, and then we all kind of trade with each other, and let's say we trade for, let's say like a minute, or not a minute. Let's say we trade for 5 seconds and we do like 3 trades, and then now we want to actually write down who has traded what, right? We want to make sure that this is written down.
So you have to verify it correctly.
Yeah.
If you don't verify it correctly, you lose it basically.
No, it's just like kind of that 5 second is like the block time. So anything happens within the block, it's not confirmed. It's just kind of still in this like weird state where the trade happened, but it has yet to be entered into the historical ledger, so that the funds are actually transferred between wallets. So yeah, I'm in a room with a few other people. We trade for 5 seconds, and now we want to actually verify that all the trades we've done are good, and we want to write them down on a piece of paper, and then we want to have that paper stored in a permanent record, so so things are finalized. So what's a mechanism that would allow all of us to act honestly? So let's say perhaps the mechanism is that everyone would then put money kind of into this pool, and then someone would propose, hey, I think this is the list of transactions that just happened, and then everyone who has money in the pool would then vote on whether this list is true, and then you kind of just go with majority there. So kind of the game theory optimal solution, assuming you have a close to an infinite number of people trading, is in fact to just vote on the transactions you actually saw / the transactions you believe actually happened, and that's essentially what staking is, where the optimal solution to do is to vote for what's true, and then as a consequence, the protocol, it's just code, would generate additional Ethereum and just give it to all the people who voted.
But why would someone not vote as to what's true? Why would someone lie?
Someone who like, let's say you own 80% of Ethereum or 80% of staked Ethereum, and then you propose a fake transaction record where everyone gave their money to you, and then you vote that that is true, and then that is the majority, and then because what is money? Money really is just a record on a ledger, right? That ledger goes into historical record, and then that ledger now says everyone has sent money to you. So now you have all the Ethereum in the world. But then, as you can see in that case, if there actually is a proof of stake attack on Ethereum, the problem is not just to the people who are staking Ethereum. The problem would be to Ethereum itself, right? Like, it would no longer be a safe currency.
But so to what extent how is this not just an unlimited amount of money? Like you stake up, you ramp up the leverage, you get 2 to 7%. What are the risks, right? If you're literally just stating what happens in the market, and as a individual investor, you're doing it, Freeport is doing it for them, verifying it using game theory or whatever sort of algorithms you have, and it's backed by insurance, whatever. What are the risks? Like, where can someone actually lose their money staking?
That's the thing. I think the risks are very minimum. There's really two main danger points. One is proof of stake attack on Ethereum, which has never happened and probably never will. And two is kind of somewhere along this financial plumbing, something gets hacked and you lose your money. But then that's kind of the same level of risk as, say, you keep your money in a bank gets hacked, you lose your money. So insurance is the way to insure against kind of technical failure on the financial plumbing, not really
Wait,
the
so
staking.
wait, so it's actually Ethereum, the network itself, is giving you more Ethereum.
Yes,
That's what staking is. Right, but what
that
about
that's what staking.
is it also known as staking if, say, something like Binance needs to manage their risk book and they're underexposed to Bitcoin and they need to borrow more Bitcoin, or would that be known as something different?
That would just normal lending would just be what you want to call it.
That's just normal lending. Okay, so
Yeah.
this is specifically for the network itself. And why would Ethereum want to pay people to verify transactions? Is that just the way it remains, keeps
It's
the
just the way it does it. I
decentralization?
think, yeah, that's the way you can keep it decentralized. It's called proof of stake. It's not just Ethereum, it's any proof of stake token. Anything built on Ethereum is typically also proof of stake. So, something like Bitcoin, I think, for example, if you just look into news, it's proof of work where computers are just solving problems to, use blocks to verify transactions. Very energy intensive, not the most, sustainable form of verification in terms of just the energy consumption there. Uh, but yeah, I think, with the proof of stake tokens, people are like, hey, this doesn't actually require all that energy. It uses game theory, it uses economics instead. So yeah.
So if this is such like a profitable thing in terms of staking itself, you've sort of you found this problem, and there's many bigger companies that allow for staking. Why isn't someone like Coinbase? Why are they not allowing people to have their own individual wallets and their keys to access them themselves, and then taking a cut similarly to what you do? And if it was cheaper to just keep them all within their own big wallet, why wouldn't they allow this solution now?
Yeah. So I think Coinbase and Robinhood does in fact allow the solution, and they do take a cut, but it's it's slightly different. So I think first Coinbase definitely takes a way bigger cut than Robinhood and Kraken, and I guess like the question here is why do people keep their money in a checkings or savings account when they can keep it in a money market fund, right? If you keep your money with a bank, you're in a checkings account, you're losing 4.5% a year. In a savings account, you're maybe losing 2.5% a year that you could get risk free. So I think it's the same thing with Robinhood and Coinbase because they have all those customers, all that flow already. People don't want to move, so they rather prefer leaving money on the table. So for us, we're closer to kind of being that money market fund or ETF where we connect the consumer very directly with the actual source of yield in DeFi. And then, when you're like, why isn't this a race to the bottom? And I'm like, if it is a race to the bottom, then, it's a race to the bottom where the unit economics works better for us. Because again, we're non-custodial. We don't actually hold custody of your assets. You just kind of plug in your own self-custody wallet. What that means is significantly less overhead for us because we're no longer holding custody. We don't have to build the systems to ensure that this custody is safe, because you just have your private key, it's already safe. We don't need to build the entire legal teams, entire engineering teams, entire financial teams to have all of those additional personnel costs just for you to be able to do what you want to do. Instead, every economic function that's being, I guess, done by Coinbase employees right now, or Coinbase systems right now, can be done by a DeFi protocol, and we're kind of just can be done by code basically, and we're aggregating these protocols and presenting them directly to you.
And how do you get a cut of the money? How does your business make money?
It would just be the same model as Coinbase and Robinhood, where for us, because it is cheaper for us to provide these things to you, because we don't have to hire as many people, because we don't have to build as many systems, we're able to take less of a cut. So let's say you're staking your ETH, you're getting maybe 4.5% a year. You would now be getting 4.4% instead of 4.5%.
So as the staking money would come back, you would get a percent of the transaction,
Yeah.
and that would be
or
okay.
or when you're trading on our platform, we would also take a little cut. So
Okay, so you need minimal overheads for this business. There's this way to make money. Obviously, there's no such thing
yeah.
as free money, but very low amount of risk relative to the amount of reward in which you can get 2 to 7% for staking your money, in which people are already kind of exposed to Ethereum and Bitcoin for investors that are long term. You've built up your own nest egg, as you describe it, for the next few years. Your co-founder also made $200,000. Why then go look for investors? Why try and get in the likes of Y Combinator? And what was that process like? What do you think differentiated you? And do you think these VCs are just throwing money at anyone and everyone with crypto, or do you think that there will be these winners that shine through?
So I think with respect to someone like Y Combinator or Alliance, our second investor, I think one of the major kind of blockers for a product like ours will be trust. Right? How do we get people to trust us with their money? So one way we're doing is, we're building in public. A lot of DeFi projects, the founders are anonymous. No one knows who they are. But for us, you can see we're posting on LinkedIn, we're posting on Twitter. We're trying to make sure that people know who we are, putting ourselves out there. And the second thing is we want to, be able to be associated with credible people, investors that's well known by the rest of the world, to show that again we're a legitimate product, that you can trust us with your money, that we're actually trying to make this work. Because I do agree that in DeFi there are scams, right? Like it's not a secret to anyone in crypto that there are pump and dumps. There's like less than honest businesses going on, and our question is, what do we do to signal to the world that we're doing the right thing and we care about doing the right thing? And then I think part of that is being backed by credible investors. Part of that is, working together with other companies who are seen as credible.
And how did you go about actually getting into Y Combinator? And the last part of that question, like, are they just throwing money in at everyone and everything in crypto, or are you differentiated?
So I think for YC, the application process is relatively simple. You just fill out a form, and then it's a 20-minute interview. For other investors, it's a little bit more involved, where may require warm intros, cold emails, and then just set up a multi-stage process. As to crypto, I think honestly, crypto is not like the hottest thing in the VC market right now. I do think, in some sense, people are throwing money at everything that's just AI. But somewhat surprisingly, for example, in our batch, there's not that much fintech, there's not that much crypto, which actually, I guess maybe counterintuitively make us feel much better about this idea and our current direction, because the idea that we're not building AI, in fact we're building on something that has nothing to do with AI, and that people are still willing to give us money, and people giving us money are very well recognized investors, kind of make us confident that those investments are much higher signal than they would otherwise be if we were building some AI B2B SaaS company.
What do you think these investors saw in you, and how did you go about showing them that you weren't a scam and that you could actually make money and had longevity in this business?
Yeah, I think for us, on the pre-seed stage investing, I think it's very different from Series A or later investing, where really you're investing in the team. So I think for us, it was much less the idea. It was more just, to the sector, the general direction you're building in, is it viable? And in this case, crypto deregulation, it seems pretty viable. And two, just, is the team good? And I think in general, like me and my co-founder, I have a very strong background in finance, in understanding these protocols. My co-founder has a very strong background in building and running a business. So I think, they saw us, they saw that we've known each other for a very long time, that we can work together on stuff. And, they felt like it was a bet that's worth making. And I think kind of going back to the crypto stuff, if you want to just think more generally about when startups can win against big companies, you really want to be building in areas that's experiencing rapid growth and disruption. And right now, that is both AI and crypto. Like on the AI side, obviously AI as a technology has enabled ways for entire industries to, be replaced or be changed. And on crypto with, kind of regulatory clarity slowly coming in, you kind of have this gap where, big companies like, let's say, JP Morgan or Coinbase, they don't have enough regulatory clarity to kind of just like full send and move ahead. But, there's this maybe, let's say, like 18 to 36 month gap where you have enough regulatory clarity for smaller companies like us to, build, iterate as fast as possible, market aggressively, and not for bigger companies to just be like, hey, we can also try to full send into DeFi. So.
And how has that actual transition been from going about starting day one? Like, what stage of the process are you at with your company? Do you have any users yet on board? And if not, how do you plan on getting them in the future?
Yeah, so we can talk a little bit about that. I think, we've been at this for literally 2 months. Actually, the first month we built something else. It was like a different idea. And then we decided to pivot kind of in the middle and then got distracted by fundraising for 2 weeks. So for this current iteration, I think, we cooked up something pretty efficiently within, I think, like 2 weeks, and then we hosted it on the web. We started showing it to test users / our friends. Right now we have close to, I think, something like 70-80 unique wallets connected, people using it. So we implemented basic functionality like swapping, being able to see your portfolio, being able to just organize stuff, and we're just kind of adding all the other stuff that we're currently talking about. As to acquiring users, I think the first thing you want to do is you want to make sure your product is actually good. So for us, we probably would not publicly launch this thing until we're getting feedback from our friends and our test users, really close people who already know that, hey, I am literally using this every day. I'm using it instead of Coinbase. I'm using it instead of Robinhood. And that's when we know, we've hit product market fit. And if the product is actually good, then I think everything else just follows. We have the rails there, right? We're backed by Y Combinator. They can like retweet our stuff. We can do like social media advertising, just kind of throw VC money there to get visibility. Because again, visibility doesn't mean anything if people see your product, click on it, try it, and then leave because the product is bad. But I think again, as long as the product is good, everything else can just kind of be solved with both the money and the connections there.
So simply, I think 2021, around that basis, 4 years ago, Bitcoin was sitting around $10,000. I haven't checked the latest price, but now it's more than, $100,000 or more. Since Donald Trump became president again in November 2024 last year, he's been a big backer of crypto, launching his own Trump coin, and that was the Melania coin. His sons, I think one of his sons, Eric Trump, has recently become a billionaire himself, and it's this pro Bitcoin, pro cryptocurrency sort of presidency. You've obviously got a lot of the they hosted a state dinner. They have a crypto czar, I think David Sachs, and you even have in the Middle East. A lot of them are buying up a lot of crypto, and now even banks, as you mentioned, are starting to hold a lot of cryptocurrency. And you mentioned in 18 to 36 months' time, as regulation gets into place, there'll be big players in the crypto space. But I think there's this big idea that cryptocurrency is up and up and up. And as we've seen from the 2008 financial crisis, as we've seen from 2020 in the stock market, as we've seen from Liberation Day in the stock market earlier this year, it would be kind of stupid to imagine that the path of Bitcoin is just going to be this linear thing going up. But a big bet for your business is the idea that people are going to be long-term holders in cryptocurrency, in Bitcoin, in Ethereum. And if you're dealing with people with smaller size wallets, people that focus more on the emotional side, as you were when focusing on retail investing, there might be this notion to which people might want to take their money out when they can. How does your site go about, do you hold people in for a fixed 12-month period? Do you worry that if the price of Bitcoin was to fall, that you would lose a lot of users? Like, why are you betting that a lot of people are long-term holders of Bitcoin, Ethereum, etc. moving forward?
So yeah, I think I can talk about that also. So I think first, I agree with you that the path of Bitcoin is not going to be linear. The path of any asset other than treasury, short-term treasuries, none of them will be linear. However, to phrase this in another way, if you imagine that we're 100 years from now, what the financial system looks like, I feel like when people imagine what the financial system looks like 100 years from now, no one will say, hey, it's going to be exactly the same way as it is today, right? Blockchain as a technology to transfer money is just objectively better, for example, at cross-border transfers than what we currently have. And for example, stablecoins is probably just objectively, again, a better way of transferring money than, let's say like Venmo or whatever other traditional financial rail. So in terms of just
Why?
having the
Why is
financial,
that? Why is it
okay.
better?
So I think, for example, yeah, we can talk about it. So current financial system ways to transfer money, let's say Venmo, right? Like for your money to hit your bank account, it takes like maybe 2 to 3 days. Because what's actually happening is, they're sending a message to your bank. Bank is saying it received the message, then send the fund, etc. And all of these things, if you think about it, they're just all data, right? Your money really is just a entry on a bank's ledger or a bank's database. But there's a lot of checks that need to be done to make sure that these entries are being sent correctly. And these checks takes a very long time, and they're being done on very antiquated systems. It feels natural that all of these checks, changes in the ledger should just be done on, a system that could do it instantly, and a system that is secured not, by trustworthiness of the bank, but secured by cryptographic methods, either, proof of stake or proof of work. So I think, again, kind of returning to the foundational idea that money really is just an entry on a ledger, a sequence of transactions. If that's how you see money, then the natural way for money to move around would be on blockchain, right? And then the only kind of reason that this has not been achieved is because you would kind of need everyone to start using it. And that's what is happening right now. I think there was a blog by a research article by A16Z, which actually showed that crypto adaptation was mirroring the adaptation of the early internet during its first 10 years. And those two graphs tracked each other like exactly.
And so going back to that initial point of long term, why do you think people would want to be, in cryptocurrency long term, even with the market fluctuations?
So I think, again, so basically if we're saying the thesis is in the future, the financial rails will be built on blockchain. And then, these these tokens are associated with both networks and companies which are building on the blockchain. Then the natural consequence is, as the world moves more towards decentralization and blockchain technology to be used in finance, these tokens will appreciate in value. Yes, there will be volatility. And, in fact, we don't expect people to hold 100% of their assets in crypto. I think that will be insane. I personally hold something like, depending on the day, anywhere between 25 to 35% of my personal assets on crypto, and the rest of it in like stocks and commodities. However, if you are holding crypto long term, which we think you should be, alongside with stocks and commodities as a part of your portfolio, we feel like you should optimize, right? You should be able to get the 2 to 7% yield on your crypto for the next 20 to 30 years, which will compound into some insane amount of money. And we also think you should have optionality. We think you should be able to buy every single legitimate token there is to buy. Whereas on Robinhood and Coinbase, by the time a token gets onto Coinbase or Robinhood, it's already pretty big. You've kind of already missed out on a lot of the growth of the token. And we feel like, that should be made accessible to everyone.
Right. So in terms of the actual user of the site, I think my main question was kind of going back to even yourself, right? As at Quant, at some of the biggest and best companies on the planet, Jane Street, IMC, Akuna, etc. Right. Even yourself, you admitted that you can be emotional in terms of your level of trading. So I think my question stems from the idea of, right, if I'm investing and I see the market fluctuations with my sort of reptile emotional brain, there's more of a link in which I'll go, all right, I might want to sell this. But I can see in terms of if people were like, okay, I'm keeping 25%, 5%, 1%, 0.1%, whatever it is, in crypto, and I'm just going to hold on to that for the long term, then that's what that's going to be. So kind of coming into that, who would you say are your primary people that you're focusing on? Are you talking about college students? Are you talking about Gen Z? Are you talking about young professionals, older people, everyone, institutions? Like, who are your ideal people? Because if you get institutions, right, you can get less clients for a lot more money. But if you can get people like you and me, we can have less money comparatively, but you would need a lot more of them.
Yeah, so I can talk a little bit about that. So I think, for example, earlier you also asked about, withdrawing money and selling. So I'm going to touch on that a little bit. Like obviously, we're non-custodial, so if you want to sell your crypto, you're able to sell it instantly, and then as soon as you sell it, you can like kind of move your money back to your bank account. And the answer to whether if Bitcoin ever drops below $50,000 again, is that going to be bad for our business? The answer is like yes, and there will probably be hard times, but we think fundamentally in the long run this is something the world needs. As to the kind of the ideal customer profile, I think the ideal customer profile is honestly very close to the same customer profile that a Coinbase or Robinhood would have, which is kind of that mix of both just individual retail investors, of upper middle class people looking to diversify or to save, and also on the institutional side certain large firms that's looking to kind of optimize their treasuries.
But let's say you get to the point, right, of no, actually, let me rephrase. In terms of your level of safety and compliance, what sort of checks are you putting in place to safeguard people's money? Because that, long-term holding within your company is a big thing. So you mentioned you don't need complex legal teams, but do you have any compliance checks in place to make sure these things are actually safe?
Yeah, I mean, so with regard to compliance, like we don't have like a massive legal team, but we have retained a external legal team to make sure that everything we do is obviously legal. But what's legal is very, I think, different from what is safe. And on the safe side, that's something I think we care more about, where like we want to make sure that whatever, because I have my money on our platform right now, right? So I don't want to like lose any of that either.
Yeah.
So, no, I mean, I don't want to just talk the talk. If I'm going to build a product that's for consumers, like, I better have my entire portfolio on there. Anyways, so as to safety, like, a few things like we said. First, if we are directing flow to, any protocol for either staking, lending, borrowing, options, swaps, token swaps, any of those, we want to make sure that they are a legitimate protocol. And I think the easiest way to do that is, one way to just, look at who the biggest players are, reach out to them directly, see who else is working with them. So, let's say you have a decentralized exchange, and then let's say, Coinbase is already trading on this exchange. Let's say, like, Goldman Sachs is already trading on this exchange. Then, you want to do your own due diligence, but you can also rely on the due diligence of Coinbase and Goldman, who are already engaging with these protocols. So I think that's going to be the same for us, where the people we're reaching out to are already people being trusted by big institutions, and we ask them about how their things work to make sure that we read through their reports on their backing, what their protocol does, what their financial status is, what the balance sheet looks like. But we also rely on the trust of other bigger players who have already trusted their money with these protocols.
I want
I
to
think
ask
it's
you. I want to ask you. I'm conscious of time, but there's quite a few questions I want to give in, so I'm going to label them as short answer questions. The first one being, right, let's picture a world, right, in which 50 years time, 100 years time, we're both on agreement in which the financial systems of the world will be completely different as they are today. Whether it's cryptocurrency, Bitcoin, Ethereum, we can't necessarily agree on, but in terms of being different, I agree with that thesis. Let's say we get to a point where Bitcoin reaches 100,000 or some ridiculously large number, right? In terms of that currency being so high, what's driving a lot of the demand for Bitcoin is it's kind of being used as a hedge away from other commodities, other assets. Bitcoin's gone up, gold's gone up, etc. But in terms of it being used as an actual currency for cross-border payments, I know obviously you can have parts of Bitcoin, etc. But one of the benefits of fiat currency might be seen as a drawback in terms of increasing inflation is that they can produce more of it. And so it can work for wealth redistribution in terms of people in the US, the UK, etc. Do you think there's any threat to cryptocurrencies around the world that if they get to a point where cryptocurrencies are so valuable that a country like India, a country like the UK, a country like the US might actually make it illegal? And so although it's worth a lot in theory, it can't actually be used within that country.
So yeah, I can talk a little bit about that. So I think short answer is fundamentally, I think blockchain technology and crypto is designed to be permissionless and censorship proof. As a country, you can make crypto illegal. You cannot physically prevent someone from accessing the network, and you physically cannot identify who the exact person is accessing the network. But they would need to know the technological know-how in order to do that. So I think fundamentally there is kind of a ideological thing going on, I think, in crypto, where the technology is trying to shift people's relationship with their governments by saying that their money and the assets they're holding should not be controlled by their governments. So I think maybe there is a chance, for example, in China, Bitcoin and other crypto is already being made illegal. There's a chance that this happens. I think, in freer countries. But fundamentally, I think the technology tries to, prove itself against that.
Because I think the threat is not necessarily just being able to access the value of it, but I think a lot of the value is driven on the notion that it will be used for payments within countries. And so if countries were actually to make it illegal because it was threatening wealth redistribution or threatening the idea of their own fiat currencies doing well, they might remove it. The next short answer question, what do you think is the biggest thing stopping you right now from succeeding?
There's a few things that I think we like on top of my head on like what exactly I think to build. So I guess honestly the biggest thing is actually building out the full product because we have a working prototype right now, but like ideally we actually kind of have one with all the basic features that we feel like people actually want or people have told us they wanted. And then if we can start getting those into the hands of actual users and then getting feedback, I think that will be good.
How do you plan to scale and build a team?
Scale and build a team. Yeah, so I think this is actually a very pertinent question because I think hiring for growth stage, super early stage startups is pretty hard. So for us, kind of our idea, like for product side scaling, we already talked about this. Basically, you want to just advertise as long as the product is good. It's the product driven thing. As for hiring people, I think ideally you do just want to interview people who are aligned with you, and that's kind of hard. We actually been trying a few AI tools, just scanning. I forgot the name of the AI tool. I think it's called Happenstance or something. But you can put like your entire like network in there, and then you can just use natural language to try to find people for, what exactly you want to do. And that's something I think we're thinking very deeply about, which is where do we find people who believe our thesis and have the technology capable, abilities to actually help us achieve this. It's a hard question, and honestly, I don't have the perfect answer.
In terms of actually maybe not growing your base, but in terms of actually spreading it, I would probably get campus ambassadors. So you could get one person at each university across the US, interview them, make it seem special. They can put it on their resume, give them a, I don't know, $1,500 grant for the semester. And you can get that at Duke, Harvard, etc. And then they can basically be the people that would go and get people to sign up on your site. An app that did this really well was Fizz, which basically is an anonymous posting platform, which is on more than 230 college campuses, uses basically a hyper-localized approach in which the name of the app is just for Duke, just for Harvard, etc. And so I think that hyper-localized approach of having someone boots on the ground could be really good for your thing. My next question is, how do you go about building a moat?
Building a moat, yeah. So I think fundamentally, as I think I briefly touched this before, what you really want is you want to have a very good product, and then you want to have a relationship with users. Once users are on your platform, you want to make sure, not you want to make sure, but there would be a natural switching cost, and you just want to make sure that the product is good enough that people never want to switch. This is not the best comparison, but I think the most similar thing to what we're trying to build that has been built before that was somewhat successful would be something like FTX, where it was the platform where when anything new was launched, you will be the first to be able to trade it. Anything you actually wanted to trade, you're able to trade. Anything you actually wanted to invest in, you would actually want to be invested in. The main difference, of course, we don't hold custody of your assets where FTX did, and hopefully we don't turn out the same way they do, and I also don't think we will. So.
I was interviewing, I've started this new portion of Personable in which every Monday I interview a hedge fund manager, VC, or investment banker with more real-time markets news. And something with a hedge fund manager from 2 weeks ago now was with a guy called Stephen Roberts. He made a lot of money in the financial crisis and is now basically building his own fund called All Guy Capital, trying to 10x his money over the next few years. And something very interesting he said was that if you look at the Magnificent Seven over the past 10 years, many times throughout those 10 years, people would say they're too overvalued, you shouldn't invest in them. The actual alpha and the money to be made is elsewhere. But if you were to look back at a fund manager over the past 10 years, you would see that every single time you should have bought those stocks because they made an extraordinary amount of money. And I think that's a similar thing with my own relationship with crypto, because I've always been very skeptical with it. You have that Warren Buffett sort of quote idea in which it's don't invest in things you're not both interested in or know about. But actually seeing how well crypto has done, don't expect me to pour my money into it tomorrow. I still think it's very overpriced relative to where we are. But if I wanted to educate myself on crypto, or for a listener that has got to this stage in the podcast that wants to learn more about cryptocurrency from the ground up, why it has the potential to do well, and actually understand it from a fundamental level, what sort of resources or ways do you think someone should go about learning more about cryptocurrency?
Okay. So I think, yeah, fundamentally, I think one of the issues with the industry right now is there isn't great resources. I think the ones I recommend the most probably would be just from Robinhood, Coinbase, Kraken, Gemini. They write articles about exactly how these things work. They have entire teams of people kind of devoted to education because, it's in their best interest. So I think, yeah, definitely just check out the big exchanges, the big crypto brokers on their websites about how, any of this works. And in general, you can trust them. They're credible. They're big companies. And yeah, they usually explain things pretty well.
And do you think investors should look at it from an allocation basis? Or do you think I should be looking at, like, if I wanted to get into it tomorrow with a small amount of capital, should I be looking at the big names like Bitcoin and Ethereum? Or should I be looking at shorter coins in order to build up my investment basis? If you're looking at stock, you might have, the big names in there. But you also, if you actually want to generate returns, you might need to look at new names as well.
So I think, again, depends on how much time you want to devote. So like for me, I obviously devote most of my time to building this company. So I'm not looking into a lot of stuff. So most of my crypto, which is I think now like kind of like a third of my portfolio, all of it's in the top 10 market capitalization of tokens. And then same with my stocks, like any of the individual stocks I hold is like a top 50 market cap stock and it's mostly diversified ETFs. So that's what I recommend for people who don't want to spend too much time looking into stuff. Definitely just go with the big token names, market cap weighted or like equal weighted, whatever you want. For people who want to go really, really deep, I think if by the time you've gone really deep, I think you already know what exactly you want to buy.
So I've got four final questions, one of which is, what is a question that I haven't asked you on this podcast or that people don't ask you enough that you'd like to talk more about?
I think maybe on this podcast, or actually just in general, like I think it would have been exciting to talk about the trading opportunities in DeFi right now, and why there are some trades in DeFi right now that anyone can do that kind of generates above market risk adjusted returns that just exist and hasn't been arbitraged away because the players with the big balance sheets aren't able to come in and actually kind of bring equilibrium to this market. That's something that I think would have been exciting to talk about.
And in short, what are those trading strategies? How to find them, and what should you do?
Something like you can look it up. Ethereum basis trade, Solana basis trade, any of the basis trades where you provide liquidity on the perpetual future against the spot is pretty good if the perp trades a premium persistently. And also diversified market making vaults. Look up hyperliquid HLP. I think that, and also there's a thing called variational, where again, like kind of diversified market making liquidity provision seems in crypto at least to be yielding above market risk adjusted returns.
And I hate to chuck in a subset of that question, but what's the explanation of a 5-year-old to what those two things are?
To those two things are, I guess market making is just like you're both buying and selling, so that's somewhat easier to explain. And then there's algorithms that both buy and sell. And
But how would you do that as an individual investor? I know how you would do that from
yeah,
a bigger market maker basis, but how would you do that as someone with $1,000, for
yeah,
example?
yeah.
How would they
So
provide
like
liquidity?
on DeFi, there are vaults like run by these exchanges themselves where you can give the exchange money and the exchange will give you the returns from their market making activity. So that's something you can put like I'd say like a small amount of your money in, and those are generating like decent returns. And then the other thing is the basis trade. Wow, this is hard. Uh, I don't think there's a good way to explain it to a 5-year-old, but basically, I think one way to think about it is, there's two assets. Both of them represent the price of Bitcoin. One's an actual Bitcoin. Another one is something that pegs its price to Bitcoin and should theoretically trade at the same price and has a mechanism that makes it trade at the same price to Bitcoin. And one of them, and they're just trading at different prices right now. So you should kind of sell the expensive one and buy the cheaper one.
And why would an exchange allow people to provide their own liquidity? And then why would someone like Citadel Securities, Jane Street, Akuna, why would they not allow an an individual to add their own liquidity to their trading algorithms?
So I think in DeFi there is the ethos that everything should be decentralized, everything should be permissible. So for example, the hyperliquid vault I was talking about, one of the reasons that the exchange is so successful is because they've built up trust with the community, that they allow people to put their money into their liquidity provision services and get returns from that. So I think it's something that they just ideologically care about. Whereas again, for like a Jane Street or Citadel, for them, they don't feel like they have that obligation.
So 3 final questions. These are more focused on holistically over your life, as more of a transition from crypto basis to you as a whole. If I was to ask someone in 100 years, how would you want to be described and what would you want your legacy to be?
Damn, 100 years, the legacy. I don't know. Hopefully, he was someone who spent his life building for something that he believed in. I think. Yeah.
And you can choose any basis of time that you want, but what's next for you?
What's next for us?
For you.
For me,
For you.
after this call, I'm gonna go grab lunch slash
I know the
breakfast.
next 3 months, 6 months, year,
So
etc.
yeah, I mean, I guess if we're looking to, I think maybe we're working with a team to get our landing page done, and once that's done, we're looking to kind of just actually publicly launch this thing, assuming built out good feedback from test users. Ideally, 6 months. I think we have kind of basically all the features we need. It's a complete platform. We've got maybe let's say like a few $1 million ARR coming in, and we just kind of go growth stage from there. Just keep getting user feedback, keep making it better. I think fundamentally, this business, at least my business, is not something that's like a groundbreaking technology. It is just fundamentally trying to create a product that solves a problem that real people are having, or multiple problems that people are having. And it is probably going to be more like iteration based, slow growth based, rather than be like something that took off like ChatGPT or something.
And my final question, and I ask this to every guest on Personable, is what is one thing that you would want a listener to take away from this episode?
One thing. I think honestly, just I think there should be more people who are more open-minded about crypto. Again, I think the typical person, no, I don't think anyone should be putting, let's say, more than 50% of their portfolio in crypto. And honestly, the typical person shouldn't be putting over 10% unless they feel confident about what they're doing. But it is a pretty big opportunity. I think, right? Like for example, I think it is similar to what technology stocks are in the early 2000s, and you can see what happened if you bought technology stocks, I guess right after the dot-com bubble, where there is tremendous potential for what is to be done, and just learning about that I think is both like intellectually engaging and potentially good for people's future returns. And of course, not investment advice, none of that. Consult someone professional before actually investing.
Well, thank you very much, Lihong. It's been an absolute pleasure to meet you and to speak to you today on Personable. I feel like we've delved in a variety of topics ranging from cryptocurrency in a whole to your time at the quantitative trading firms to actually starting Freeport. I think there is something before people start a business and for people that haven't started a business in which there's this notion of what do I do? How am I going to start? What am I going to do? And I think there's this thing within trading and within finance in particular, or in high finance. I mean, I haven't even started my internship yet, but there's this notion of having conviction in the ideas that you have. And so when I first asked that question of, oh, you're just going to drop out and you're going to start this business. But now having actually spoken to you for an hour and 10 minutes, I can see that the conviction is not from having the perfect product, but having the idea generation and seeing the problems and seeing why you can fill that gap. And I think that for anyone starting a business, it's not just about the how, what if, the whys. There's a level of uncertainty to everything we do, but it's about surrounding yourself with the right people, getting the right skills, getting the right financial backing, building up your own nest egg, as you started off by talking about at the beginning of the podcast, which is incredibly important. I feel like I've learned a lot. I'd love to stay in touch, and thank you so much for coming on the podcast today.
All right, of course. Thank you for your time.